For a long stretch of time, Florida's real estate scene seemed unstoppable. The Sunshine State became the ultimate destination for people on the move, attracting remote workers, retirees, and savvy investors from all across the U.S. Rental prices skyrocketed, condos were being flipped like hotcakes, and property owners proudly called it the modern-day gold rush. But now, in 2025, that gold rush feels more like a slow-motion crash. Florida's rental market is unraveling, and it's happening much faster than anyone saw coming. Rental rates have surged to levels not seen in over 10 years, and it's pushing the market to a breaking point. Many developers who poured resources into luxury apartment complexes during the pandemic boom are now scrambling to fill vacant units, and the very investors who once boasted about effortless profits are now desperately hunting for tenants. Recent data from Zillow and Realtor.com reveals that average rents across Florida have dipped nearly 7% over the last year, and in certain cities that drop is approaching 15%. So what's behind this sudden downturn? It's a perfect storm. Too much new construction, sky-high insurance premiums, wage growth that's barely budging, and a noticeable slowdown in people moving to the state. Landlords are offering perks left and right, from free months of rent and waived deposits to gift cards just for signing a lease. The tide is turning, and renters are finally getting the upper hand. Welcome to Discover the Cities. Today we're counting down the top 10 Florida cities where the rental market is sinking the fastest. And hey, before we dive in, don't forget to hit that subscribe button and turn on notifications. Every week we break down the biggest trends shaping the future of housing across America. Let's get into it. Number 10. Fort Lauderdale. Once known as a shining beacon of coastal luxury, Fort Lauderdale is starting to feel the cold winds of a rental market correction. For years, it was the go-to escape from Miami's sky-high housing costs, offering similar scenery with a smaller price tag. But that affordable alternative title, it's officially gone. Vacancy rates in the city have doubled since 2022, now hovering around 9%. Just a couple of years ago, the median rent for a two-bedroom apartment was sitting at $3,200. Today, that number has slid to about $2,700. Developers who once stacked glass high-rises along Los Olas Boulevard are now dishing out free parking, rental credits, and even gym memberships to lure in tenants. So what went wrong? It started with a wave of investor optimism. Many believed Florida's migration boom, especially from the Northeast, would never slow down, so they built fast and expensively. But local renters couldn't keep up with the pricing, and suddenly the supply outpaced the demand. Then the insurance crisis hit. Thanks to rising flood risks, hurricane threats, and climbing repair costs, some buildings are now facing annual premiums topping $7,000 per unit. And if that wasn't enough, utility costs have surged nearly 20% in just a year, squeezing renters' wallets even further. Early 2025 brought another blow, a slowdown in tourism. That dip has only widened the vacancy gap. Broward County now says nearly 1 in every 10 rental units is sitting empty, a massive jump from the 4% vacancy rate pre-pandemic. Making matters worse, tightening restrictions on short-term rentals have pushed thousands of Airbnb-style properties back into the long-term market, just as demand started shrinking. Neighborhoods like Flagler Village and Victoria Park, once bustling with life, now show rows of dark balconies and vacant units. Property managers are working overtime, calling daily with special offers. New luxury complexes are opening their doors with half their units still unrented. Even longtime landlords, the ones who once never had to negotiate, are slashing prices quietly to stay competitive. Fort Lauderdale's rental boom has officially flipped. What was once a story of non-stop growth has turned into a cautionary tale, a stark reminder of what happens when blind optimism outruns economic reality. Number 9. Orlando. Known for theme parks, family getaways, and a thriving convention scene, Orlando has long been the beating heart of Florida's tourism machine. But here in 2025, the magic is starting to fade. Vacancy rates across the metro have climbed to 9.5%, and the cost of a one-bedroom apartment has slid from $1,900 to just $1,600. Across Orange and Osceola counties, over 15,000 apartment units are sitting unrented, the highest number on record for this region. So what's driving the downturn? It's simple. The market got flooded. During the pandemic, developers went all in, building aggressively in hotspots like Lake Nona, Winter Garden, and downtown Orlando. The gamble was that remote workers and hospitality employees would keep filling those units. But when hybrid work became the new norm and theme park attendance plateaued, that demand started to vanish. Tourism is still alive, yes, but wages haven't kept up with the rising cost of living. The average hospitality worker in Orlando makes around $41,000 a year, which barely scratches the surface of what's needed to afford even a modest lease. More and more residents are packing up and heading to smaller, more affordable towns like Claremont, Eustis, and Ocala just to make ends meet. And then there's the Airbnb effect. thousands of short-term rental owners have shifted to long-term leasing, dumping inventory into an already saturated market. According to AirDNA, over 6,000 former vacation rentals have become standard leases since 2023, pushing vacancy rates even higher. Even the city's most upscale complexes aren't immune. Properties near International Drive and the mall at Millennia are now dangling multi-month rent concessions just to stay afloat. These luxury buildings, once celebrated for offering a resort-style lifestyle, are now fighting to fill empty units. In some neighborhoods, rental prices have fallen by nearly 12% from their peak, the steepest drop the city's seen since 2009. For years, Orlando represented the dream, a booming market powered by sunshine and non-stop visitors. But today, it's become one of Florida's sharpest corrections, a real-time lesson in what happens when the tourism engine sputters and housing supply overshoots. Want more breakdowns like this? Hit subscribe and follow Discover the Cities, where we connect the dots between economic data and everyday life. Number 8. West Palm Beach. Once a shimmering haven for the wealthy elite, West Palm Beach is now one of the clearest signs that Florida's rental market is coming back down to earth. Vacancy rates have crept past 9%, and rents for two-bedroom apartments have dropped nearly 11% in just the past year. Downtown West Palm alone has seen a flood of construction, more than 4,000 new high-end units added since 2021. But the problem? Demand hasn't kept pace. Back during the pandemic, Palm Beach County became one of the hottest relocation spots in the country. Wall Street firms opened satellite offices, luxury towers filled almost overnight. Landlords cashed in, hiking rents at will, but now that wave has reversed. A significant number of remote workers have returned to financial hubs like New York City and Chicago, leaving hundreds of new apartments sitting vacant. Developers who bet big on long-term demand along Flagler Drive and Rosemary Square now find themselves overbuilt and underoccupied. Insurance costs have become another heavy burden. Premiums for many oceanfront properties have doubled, forcing smaller landlords to either sell or eat the losses. And with property taxes up nearly 9% in just 2 years, the financial pressure is mounting fast. The ripple effects go beyond just housing. As high-income renters leave the area, foot traffic declines and once busy retail districts are starting to look half-empty. Even local restaurants and service businesses are feeling the slowdown. Meanwhile, hotel occupancy rates, a key economic driver for the area, are also down slightly compared to last year, adding another layer of concern. The median rent has slipped from $3,000 to $2,700, but even that lower price point is still out of reach for most locals. The median household income in West Palm Beach is just under $70,000, leaving many residents priced out of their own city. Behind the palm-lined streets and luxury condos, West Palm Beach is quietly undergoing a major economic reset. The energy of a boomtown has been replaced by something more cautious, a city adjusting to the reality that prosperity, especially in Florida, can vanish just as fast as it arrives. For the first time in years, renters here are holding the power, and landlords are learning some tough lessons. Number 7. Jacksonville. It was supposed to be Florida's safe zone, a market known for affordability, steady jobs, and family-friendly neighborhoods. With its strong military presence and booming logistics sector, Jacksonville was seen as one of the state's most resilient cities. But in 2025, that foundation is beginning to crack. Vacancy rates have crept up to 8.7%, and instead of just slowing down, rents are actively dropping. Across the city, average rental prices have fallen by nearly 8%, and in some neighborhoods, the cuts are in the double digits. Today, a typical two-bedroom goes for around $1,500, down from $1,650 just a year ago. What happened? During the real estate boom, developers went big, especially along the south side and near St. John's Town Center. Thousands of new units went up, all targeting newcomers from places like Georgia and the Carolinas. But that wave of migration, it slowed dramatically. According to the University of Florida's Bureau of Economic and Business Research, population growth in Duval County has dropped by over 40% compared to 2021, and yet construction never really stopped. Another 8,000 rental units are still on track to be completed in 2025, adding even more pressure to an already saturated market. Then there's the cost crunch. Insurance premiums have surged nearly 30% in just 2 years. Maintenance expenses are also hitting new highs, forcing smaller landlords to raise rents just to stay afloat, even if it means pushing out longtime tenants. In historic neighborhoods like Riverside, San Marco, and Springfield, for rent signs now sit untouched for weeks, sometimes months. Desperate to fill units, owners are offering perks like free utilities, waived security deposits, and move-in credits. Even the big-name property management firms are cutting rates, in some cases by $200–300 a month, just to stay in the game. Yes, Jacksonville still benefits from a diverse economy and a strong shipping industry, But the housing market? It's clearly overreached. At this point, the question isn't if rental prices will bounce back, it's when and how long it'll take for the supply and demand scales to find their balance again. Number 6. Naples. For years, Naples was the ultimate postcard of Florida perfection. A serene blend of white sand beaches, palm-lined avenues, and sunset-soaked skies. It embodied the dream of coastal living, quiet luxury, warm breezes, and a housing market that seemed untouched by economic gravity. But in 2025, even paradise is starting to feel the cracks. Vacancy rates have surged to nearly 10%, the highest level Naples has seen in more than a decade. And rents? They've tumbled over 10% in just the last year. Units that used to rent for $3,500 a month are now sitting idle at $3,000, often bundled with perks like free rent, waived deposits, or even gift cards just to get tenants in the door. So what changed? The city's problem is a simple but sharp collision between oversupply and rising costs. During the boom, developers flooded the market with high-end condos and seasonal rentals, banking on a steady stream of wealthy retirees and snowbirds. But now, many of those buyers are rethinking their second homes. In Collier County, property insurance premiums have skyrocketed by more than 60% since 2021. Add in rising HOA fees, maintenance bills, and spiking utility costs, and even the most affluent homeowners are starting to pull back quietly. And it's not just the housing side that's cooling off. Naples' once robust local economy is starting to lose steam. Tourism is down, visitor spending has dropped nearly 8%, and the hospitality sector is scaling back, with resorts and restaurants trimming hours and cutting staff. Take a stroll down Fifth Avenue South, once buzzing with fine dining and boutique shopping, and you'll now spot more for lease signs than you have in years. Younger professionals are also leaving the coast behind, relocating to inland towns like Ave Maria and Lehigh Acres, where rents are significantly lower and insurance costs more manageable. Their exit has drained some of the vibrance from Naples' polished core, leaving luxury units quiet and sometimes completely vacant. Number 5. Sarasota. Once the jewel of Florida's Gulf Coast, Sarasota was a place where culture, beauty, and economic optimism all seemed to align. Between 2020 and 2023, the city saw one of the fastest rent increases in the nation, over 40%. But by 2025, that rocket-fueled growth has reversed course. Vacancy rates are nearing 10%, their highest level in over a decade. Average rents have dropped almost 9%, and a typical two-bedroom that used to lease for $2,600 now goes for about $2,300. What was once a landlord's dream has flipped completely. Now property owners are offering perks they wouldn't have considered just a few years ago: free parking, waived fees, rent credits, and more. Developers had been building fast and furiously during the boom, flooding the market with thousands of luxury apartments and resort-style complexes across downtown and surrounding areas. Since 2022, over 7,000 new units have opened, but many are struggling to find tenants. Some buildings report occupancy rates hovering around 60%, a warning sign in a city that once couldn't build fast enough. Skyrocketing insurance rates aren't helping either. Along the Gulf Coast, costs have surged. New flood zone designations are making coastal living more expensive, especially in popular spots like Siesta Key and Lido Key. Renters are responding by heading inland to places like Bradenton or Port Charlotte, where they can cut monthly housing costs by as much as a third. Economic data confirms the slowdown. Retail vacancy is up 6%, hospitality jobs have plateaued, and population growth has fallen to its slowest rate in a decade. Sarasota isn't crashing, but it is correcting. The city's housing prices simply outpaced what everyday incomes could support. Now the market is settling back to earth. For renters, it's a breath of fresh air. For landlords, it's a harsh reminder. Even the strongest booms eventually reach their limit. Let's talk about Tampa, which is number 4 on our list. Remember when Tampa's real estate market was practically legendary? During the pandemic, it completely exploded, swiftly becoming one of the most rapidly expanding metropolitan areas in the entire country. We saw thousands of remote workers relocating from the Northeast and the Midwest, and for a long time, that intense growth seemed like it would never stop. But now, in 2025, that feverish boom is distinctly fading. We're currently seeing a noticeable increase in vacancies, which have jumped to 9%, and apartment rents have actually declined by roughly 8% compared to last year's peaks. This downturn is hitting the luxury segment the hardest, especially in coveted areas like Channelside, Water Street, and Ybor City. For instance, downtown apartments that once fetched $3,000 are now sitting vacant at $2,700, often sweetened with incentives like complimentary parking or waived security deposits. The issue? Developers went on a building spree, bringing over 10,000 new units to the market in just 3 years. confidently betting that the migration frenzy would maintain its record pace. However, those new resident inflows have significantly slowed down. According to recent housing data from the University of South Florida, the number of new arrivals has dropped by almost 30% compared to the peak in 2021. Simultaneously, the cost of simply living there has skyrocketed. Insurance rates have effectively doubled across much of Hillsborough County, and recently updated flood maps have further intensified operating expenses for property owners. This means Tampa's famous affordability advantage has pretty much disappeared. Tenants who initially moved south to escape the high prices in places like Miami are now finding themselves paying almost the same amount, even though local wages haven't kept up. The median household income for the area hovers around $73,000. Yet the average rent for a two-bedroom apartment still exceeds $2,600. That massive housing expense forces many families to dedicate over 40% of their earnings just to keep a roof over their heads. The market shift is clear. Even downtown leasing offices are now competing fiercely for occupants. It's now standard practice to offer giveaways like 2 months of free rent, complimentary utilities, or prepaid gift cards. The frantic atmosphere of 2021, when landlords were juggling multiple applications within mere hours, feels completely ancient. Today, Tampa's skyline still gleams with construction cranes. But beneath that visible building activity is a market actively struggling to absorb its own overwhelming excess supply. The city that once stood as a powerful symbol of limitless opportunity now serves as a sober reminder. Even the hottest real estate markets in Florida can rapidly cool off when the pace of supply outstrips actual demand. Now for number 3, Miami. Miami has always been the superstar of Florida's housing narrative. It felt absolutely untouchable, glamorous, and like it would expand forever. For years, it set the standard for global luxury, where those stunning ocean views could demand insane, record-breaking rents, and every new skyscraper seemed taller than the last. But here in 2025, Miami's seemingly unstoppable ascent has finally hit a serious snag. Vacancy rates have spiked to almost 11%, the highest they've been since 2010. The average rent for a simple one-bedroom unit, which used to be $3,800, has now fallen to around $3 In fact, many of the downtown areas have seen prices drop by close to 15% from their highest point. The sheer momentum that once defined this market has suddenly vanished. The root of the problem? Developers kept building as if demand would literally never end. From Brickell to Edgewater, glass towers shot up everywhere, with many specifically targeting international investors instead of regular long-term residents. When the global markets cooled down and foreign buyers retreated, Miami was stuck with an enormous oversupply of high-end apartments that hardly any locals could actually afford. Between 2021 and 2024 alone, Miami-Dade County added over 25,000 new rental units, completely flooding a market that was already struggling. Then came the insurance catastrophe. Premiums for coastal properties have totally exploded, often costing property owners more than $10,000 per unit annually. This has small landlords scrambling, forcing them to slash rents or offer huge concessions just to cover their basic operating costs. Even the city's famous short-term rental sector has taken a massive hit. New regulations have effectively cut the number of Airbnb listings in half, pushing thousands of former vacation properties onto the long-term rental market. The outcome is a colossal oversupply, something Miami hasn't experienced in over a decade. Today, you see available now banners hanging in Brickell, Winewood, and downtown, places that used to feature long waiting lists. Leasing offices are now offering previously unheard-of deals, including discounts like up to 3 months of free rent on a 1-year lease. For decades, Miami was the very definition of coastal affluence and endless appetite for housing. In 2025, it marks a definite turning point. The city was built on the expectation of limitless growth, but it's now facing its very real limits. For the first time in a generation, the aspirational dream of Miami living is colliding with the harsh reality of economic correction. Next up at number 2 is Cape Coral. There was a time when Cape Coral stood out as Florida's most rapidly expanding rental market. Its unique network of canals, abundant waterfront properties, and comparatively low prices made it an immediate favorite during the pandemic, attracting both retirees and remote professionals in droves. But now, in 2025, that powerful wave has definitely pulled back. Vacancy rates have shot up past 11%, and average rents have decreased by nearly 12% from their 2022 peak. We're seeing 2-bedroom homes that were renting for $2,200 now available for $1,900, sometimes sitting empty for weeks without a single inquiry. The long-term effects of Hurricane Ian are still drastically impacting the city's economic reality. Thousands of homes that were rebuilt or repaired have recently re-entered the market, causing a huge surge in available supply just as the pace of migration began to slacken. Exacerbating this, insurance premiums have effectively doubled in many neighborhoods, and the sharp increase in power costs is pushing numerous households to seek more affordable housing inland. Developers had confidently assumed a non-stop influx of retirees and out-of-state workers. Instead, population growth in Lee County has essentially flatlined. State housing data confirms that, in 2024, new construction completions actually outnumbered the incoming renters by more than 2-to-1. At the same time, the affordability advantage that Cape Coral once boasted has been completely eroded by rising expenses. Utility bills are, on average, 30% higher than they were in 2021, and property taxes have climbed by almost 9% in just 1 year. As a result, many middle-income renters are actively moving to nearby Lehigh Acres and North Fort Myers, where monthly rents are hundreds of dollars lower. Unsurprisingly, the once booming construction sector is rapidly slowing down. Builders are setting aside projects, and realtors are reporting a record number of cancellations. Investors who bought properties at the height of the market are now forced to offer discounts or lease-to-own deals simply to cover their costs. Cape Coral's market crash is the clearest indication yet that Florida's housing cycle has definitively turned from a period of aggressive expansion to one of pure survival. The canals still look beautiful, but underneath that glistening surface is a market fighting desperately to stay afloat. Finally, at number 1, we have Pensacola. This is a city that very few people ever anticipated seeing on a list like this. Famous for its major naval base, its immaculate beaches, and its charming small-town atmosphere, Pensacola was long viewed as essentially recession-proof. Yet in 2025, even this beloved Gulf Coast destination is visibly suffering from the state's rental market correction. The numbers are striking. Vacancy rates have absolutely soared past 12%, making it the highest in all of Florida. While rents have fallen by close to 13% year over year, the median price for a standard 2-bedroom apartment has dropped to just under $1,400. That's the lowest level it's hit since 2018. The problem, once again, is massive oversupply. Developers added more than 5,000 new apartments across Escambia and Santa Rosa County since 2020. Those units were built based on the expectation of a huge population boom that simply didn't materialize. Instead, the annual population growth rate has slowed to barely 1%. When you combine this stagnation with inflation, spiraling construction costs, and rocketing insurance premiums, the market is severely out of sync. The slowdown has been deepened by job losses, particularly in the logistics, construction, and hospitality sectors. The downtown area, once busy, now displays more now leasing banners than at any other point in the last 10 years. Local property managers readily admit that even significant rent cuts aren't filling up those empty units fast enough. Insurance rates along the Gulf Coast have more than doubled since 2021, instantly adding thousands of dollars to landlords' annual expenses. This stress means many smaller investors who jumped in during the boom are now completely exiting the market, flooding the resale market with properties. Pensacola's rental slump sends a crucial message to the rest of Florida. Even stable, well-established cities can dramatically overshoot when new construction, migration trends, and insurance costs collide unexpectedly. What was once considered the most stable coastal market in the state is now serving as its most insightful cautionary tale. Pensacola remains a beautiful place, but beneath those calm, shimmering waters lies a vital lesson in overconfidence, the kind of confidence that swiftly turns a market boom into a genuine burden. Florida's big reset. From Miami down to Pensacola, Florida's entire rental market is currently undergoing its biggest reset in well over a decade. For years, the state's housing boom was fed by raw optimism, intense migration, and easily available cheap money. Now that cycle is decisively reversing. Landlords are finally learning that consumer demand is not an infinite resource. Renters are at long last regaining some power, and Florida's future will ultimately depend on achieving market balance, not pure speculation. This is absolutely not the end of the Sunshine State's housing story, but it is undeniably a major turning point. Thank you for tuning in to Discover the Cities. If this story provided you with valuable insight, please subscribe, like, and share. Every week we dig into the real stories behind America's housing shifts and economic transformations. Because to truly grasp the future, you have to diligently follow the data that shows where the rent is falling fastest.